Hi everybody, and welcome back to video number 7 in chapter 18. And when we left off, we were looking at evidence to consider in evaluating the need for a valuation account. And in illustration of that, here, alpha, a history, this is negative evidence, a history of operating loss or tax credit carryforwards expiring unused. And bravo, loss is expected in early future years by a presently profitable entity. And then Charlie, unsettled circumstances that, if unfavorably resolved, would adversely affect future operations and profit levels on a continuing basis in future years. And for Delta, a carry forward period that is so brief that it would limit realization of tax benefits if 1. A significant deductible temporary difference is expected to reverse in a single year, or 2. The enterprise operates in a traditionally cyclical business. Now, positive evidence here, alpha, existing contracts or firm sales backlogs that would produce more than enough taxable income to realize the deferred tax asset based on existing selling prices or cost structure. And then bravo, an excess appreciated asset value over the tax basis of the entities in an amount sufficient to realize the deferred tax asset. And lastly, Charlie, a strong earnings history exclusive of the loss that created the future deductible amount. And that's the tax loss carry forward or deductible temporary difference, coupled with evidence indicating that the loss is in an aberration rather than a continuing condition. For example, the result of an unusual or infrequent item, or both. Now, if we put this all into practice, recording this loss carry forward, we'll take a look at Richardson Incorporated. And, okay, the facts. Richardson Incorporated reported the following pre-tax financial income loss for the years 2025 through 2027, as shown here. And then the pre-tax financial income loss and taxable income loss were the same for all years involved. The enacted tax rate, again, was 20% for 2025, but changed to 25% in 2026 and 27. So the instructions here, alpha, prepare the journal entries for the years 2025 through 2027 to record income tax expense, income taxes payable, and the tax effects of the loss carry forward. Assume that based on the weight of available evidence, it is more likely than not that 40% of the benefits of the loss carry forward will not be recognized. And then bravo, prepare the income tax section of the 2026 income statement, beginning with the line income bracket loss before income taxes. Okay, let's take a look at alpha, preparing those journal entries. Here in 2025, let's go back, we made $240,000, lost $180,000, and made $380,000. So in 2025, we're going to record income tax expense 20% of 240,000. Pretty straightforward there. In 2026, we had the loss of 180,000, but changed our tax rate to 25%. So our deferred tax asset is going to be $45,000 as a debit, and a credit to income tax expense carry forward for $45,000. And also, we're going to debit income tax expense for $18,000 and credit the allowance to reduce deferred tax asset expected realizable value. And that's going to be the 40% that we expect will not be utilized. Let's go back here. More likely than not, 40% of the benefits will not be realized. So we're taking 40% of the $45,000 we created here to get $18,000 of income tax expense carry forward. Then in 2027, we have income tax expense, again, 25% of our income, $95,000, and we have income taxes payable, which will be the $380,000 minus the $180,000 we had up here, and we multiply by 25% to get $50,000, and another credit to deferred tax asset for $45,000. And then finally, we debit the allowance to reduce deferred tax asset to expected realizable value, $18,000, offsetting this credit here, and then a credit to income tax expense allowance for $18,000. And then for Bravo, which they've asked us to prepare the income tax section of the 2026 income statement. Here we have the loss of $180,000, but we have the income tax benefit deferred for $27,000. And we get that by taking the $45,000 that we calculated minus the allowance of $18,000. And that results in a net loss of a negative $153,000. Okay, now we're going to change subject and describe the presentation of deferred income taxes in financial statements. Here on the balance sheet, the companies are going to report income taxes payable and income tax refund receivable as current liabilities and current assets, respectively. And two, the companies often make estimated payments to taxing authorities quarterly. These payments are reported as prepaid income taxes in the current assets section. And then finally, three, companies are generally permitted to offset any balances in income taxes payable against related income tax refund receivable or prepaid income taxes balances. Okay, let's take a look at an illustration. The Yelich Company has 4 deferred tax items at December 31, 2025. And number 1, we have rent collected in advance, recognized when a performance obligation is satisfied for accounting purposes, but when received for tax purposes. So we have a deferred tax asset of a negative $42,000. Number 2, we use straight line depreciation for accounting purposes and accelerated depreciation for tax purposes. So that results in a deferred tax liability of $214,000. Number 3, we're recognition of income on installment sales at the time of sale for accounting purposes and during the period of collection for tax purposes. So we have a deferred tax liability of $45,000. And lastly, number 4, warranty liabilities. Those are recognized at the time of sale for accounting purposes and at the time paid for tax purposes. So we have a negative $12,000 as a deferred tax asset. Okay, all totaled $205,000. So the question is, how should Yelich report deferred taxes in its balance sheet? Well, Yelich Company has total deferred tax assets of $54,000 and deferred tax liabilities of $259,000. You see that here and here. Okay. Yelich therefore reports a deferred tax liability of $205,000, the difference between $259,000 and $54,000 in the current liability section of the balance sheet. Okay, there is a note disclosure requirement, and the companies are required to disclose the total of all deferred tax liabilities, the total of all deferred assets, and the total valuation allowance in the notes to the financial statements. In addition, 1, the company should disclose any change during the year in the total valuation allowance, and 2, disclose the types of temporary differences or carryforwards that give rise to significant portions of deferred tax liabilities and assets. So let's take a look at Pepsi as an illustration. So Pepsi Company has deferred tax liabilities, several of them, and deferred tax assets, several of them, and we have a summary of the valuation activity shown down at the bottom of the page. I'll let you read that on your own, and we shall go from there. Okay, financial statement presentation. Companies are required to report income before income taxes and income tax expense on the income statement. PepsiCo reported the following amounts related to tax expense. And here they are, tax expense disclosures. Income before income taxes for 2018 through 2020, and the provision for income taxes, and finally, net income. Okay, the income tax expense benefit. Income tax expense or benefit generally equals the sum of income taxes payable or refundable and the change in the deferred tax expense or benefit. The following formula then is used to compute income tax expense benefit. So here's the formula. The total income tax expense or benefit is equal to the income taxes payable or refundable plus or minus the change in deferred income taxes. Okay, so here are the components of the income tax expense for Pepsi Company as a result, as an illustration. The components, U.S. and foreign, income before income taxes, and then the provision or benefit from income taxes for U.S., foreign, state, current, and deferred. So the provision or bracket benefit, here we are at the bottom. Okay. That looks like a good place for us to stop this video. And when we return, we'll take a look at changes in income tax expense. Until that time, bye for now.